Welcome back, everyone, to the latest What Does It Mean podcast, where we try to distill the noise that you're facing each and every day, each and every week, into some clear and coherent signal that can help shape you and the investment criteria, strategies, and more that you need. I am Chris Versace, and I am out in the mountains today, so hopefully my connectivity will be pretty good. We've got Lindsey Bell joining us from New York. Be careful, folks. There could be a fire alarm in her future. She'll tell us more about that. But most importantly, in the Boston area, keeping an eye on the Celtics, given speculation Jeff Bezos may take a bid. For the team, we have our usual counselor, Mr. Bob Lang. Team, how are we feeling this week?
Feeling good, minus this fire alarm that might be going off in the hotel room that I'm taping this from.
So you're not staying at the Four Seasons, I take it, in New York, Lindsey?
No, the budget didn't allow for that time.
So while you're up there, are you doing some media hits? Tell us what you're doing so folks can catch you elsewhere.
Yeah, I'm doing some meetings, but also media hits. I did Mornings with Maria on Fox Business today. Tomorrow I'm doing Bloomberg News. And so, yeah, I'm just kind of making the rounds up here.
Excellent. And hopefully you're seeing one or two of our old street compatriots. Hopefully you'll bump into them and do some exciting things. And speaking of the street, Bob, what's going on with you?
Not a whole lot. We're fighting the weather out here and up in the Northeast here. Believe it or not, we got some cooler weather last night. We got some rain here a few days ago. Kind of odd to get rain in August here and even in the Northeast, but we're battling it over here. Unfortunately, Chris and Lindsey, I've been feeling out of place here recently with the, I was so into the Olympics for those couple of weeks, and we've been without it for the past half, and I feel like I'm missing something in my life right now because I was really every night just parking my butt on the couch, watching all the events and watching the recap of everything, and I haven't had that for the past week or so. So I'm missing something. But you know me, Chris, I'm a big, huge tennis fan. I play a little bit as well, too. We do have the U.S. Open coming up, which will be out where Lindsey's out in New York City in about a week or so. So I'll be looking forward to watching some of that competition when that gets started.
And you and I will be seeing each other in a couple of weeks, Bob, up in the great state of New York.
That's right. New York City, I have an event going on for the traders in my chat room. I will be there in New York City, and we're taking the team over to the New York Stock Exchange. We're going to be trading for a couple of days, going out to dinner and seeing you as well. It's always been a good time. We've been doing that for the past 7 years, and so I'm looking forward to doing that as well.
Lindsey, did you like that? The way he made me like an agenda item? We'll be going out to dinner. We'll be seeing you as well. Did you like that?
Yeah, you are lucky to get on Bob's schedule. Make sure you know that.
Wow, Lindsey, I feel betrayed. I thought you were going to say, that's right, Chris, they have to book time with you. Anyway, all right. Well, look, folks, the market has been extremely strong over the last several sessions. 8 up days, the biggest streak so far this year. To put this in some other terms, the S&P 500 is kind of catapulted or rebounded, choose your words, about somewhere between 9 and 10%. Is it overbought? Not yet, if you're using the classic relative strength index definition, but we could see the market continue to chug higher. I would say continue to watch some key levels. But with that, let's get to today's episode. We're really going to try and tackle 3, possibly 4 topics. First one out of the gate is going to be which retailer earnings reports the team is focused in on and why. This is a big week for retail earnings, and this also has the potential to lead to additional downward revisions for S&P 500 consensus EPS. What could that mean for the market? We'll talk about it. Second, what does Powell need to say on Friday at Jackson Hole? Folks are out there, whether it's Evercore ISI or some others. Is it 25? Is it 50 basis point rate cut coming in September? We'll weigh in. The third big topic is one that you may not be that familiar with, which is this potential Canadian rail strike. This could be a wild card for the economy. It could even be a wild card for what the Fed might have to do in September. But we'll talk all about that. And if we have time, we'll also talk about presidential candidate Harris and the potential tax hikes for corporations that she's talking about. What could it mean for the markets and investors? Don't go away. We'll be right back. All right, folks, let's get to it. We've got 4 big topics today, maybe 3. We'll see how time goes, but let's dig into the first one. I said we were going to talk about retailer earnings and just setting the stage. Last week, Home Depot lowered its full-year guidance with EPS now declining 2 to 4%. Previously, it expected only a decline of 1%, and it also slashed its comp sales, now expecting them to fall this year between 3 and 4%, also expecting previously just a small decline of around 1%. But after that, Estee Lauder, slashed its outlook. Lowe's did the same. Team, what are we thinking here? What is going on? And how does this compare to that supposedly super strong July retail sales report we had?
I would just say that we have to really be cautious here because a lot of these companies are cutting their forecast out for the holiday season for the next couple of quarters. And usually this is, don't forget, Thanksgiving, Black Friday is the Super Bowl for retail. And if these companies are cutting estimates and their guidance for the rest of the year and even into 2025, that's trouble for retailers. Now, not every single one of these companies are doing that. I think we heard a couple of, like Walmart, didn't cut their earnings as much. But what do you think, Lindsey? I think that this could be a problem for retailers going forward. If they're just, being conservative and lowballing it, that's one thing. But I think by and large, with the economy moving much more slowly than it was at the end of 2023, I think that this could be an issue for some of these companies going forward.
Yeah, I mean, my take is what we've heard from the consumer-facing companies so far, not just the retailers. We're getting a lot of those companies reporting this week and some next week, is that consumer spending habits, they have a cautionary tone with regards to what the consumer is doing. Despite the retail sales number that we saw, you even heard a cautionary tone from Walmart, I would say. And while they did raise their guidance for the full year, it was only based on the first half outperformance. They maintained their second half guidance, which meant the third quarter expectations were weaker than what the street was looking for. So it wasn't as stellar as the market or investors had chosen. I like to say they chose to believe that it was extremely stellar. I even think Walmart's management team was a little more optimistic about their performance than what was reality, because the reality was that, according to them, their consumer focused on purchases of essential items, less so on discretionary. And that while general merchandise goods were positive, we saw a comp that was positive for the first time in what I don't even know. It was something along several quarters. That was really driven by changes in their business strategy. Not so much, they even said, not so much driven by economic changes, more so that they're offering an expanded amount of general merchandise goods in their online platform. So anyway, long story short, I think that what we are hearing from these consumer-facing companies is that the consumer is being discerning, to use a word that several of those companies have used, with the way that they are spending. They are still focused on more essential items, less so on discretionary items. And there is a slowdown in spending actually happening. And because of that, they are cutting their third quarter guidance, and they're going into the end of the year in a more cautious period. The fourth quarter, I do think the consumer is going to want to have a positive holiday experience. And I think that they have ways to make that happen through credit or HELOCs that we talked about. They have access to money that will allow them to spend. So I wouldn't be surprised if the fourth quarter for some of these retailers wasn't too bad. But I think the takeaway for me is that the consumer is slowing their spending, and the pricing pressure is expanding from the low end to the middle end of the consumer range.
I think you're spot on. I also think that the market could potentially get head faked with this stronger than expected July retail sales print. I've talked about this, but just to kind of reiterate, there were a lot of events in the month of July, Amazon's Prime Day for 2024, Target, Walmart, and other competing events that likely pulled forward retail sales from August into July, possibly even in September. If I remember what Amazon had to say, they benefited handsomely from back to school. And if you look at the various items, I think you can kind of pinpoint that. So I wouldn't be surprised if July was strong, August is going to be a little weaker. And I think some of these companies that have reported and will report they see that data already because as we're talking, we're, 2/3 of the way through August. They have a pretty good read on how that month is. And for a lot of them, it's the first month in their current quarter. Because remember, they end in July, that's August, September, October. What I will say is this: when we get companies reporting, and we'll talk more about that in a second, one of the things that I'm going to watch almost like a hawk is going to be their inventory levels. Because if the consumer is slowing, inventory levels might build up. If that's the case, it means that they are going to have to clear out aggressively in order to stock for the holiday shopping season. That means margins. That means EPS. Now, Bob, I see you're nodding. What do you think?
I agree with that, Chris. But I was also looking at a couple of charts. I was looking at the XLY, which is the discretionary select SPDR fund ETF, versus the staples. And it basically lays out the argument that Lindsey just made. Staples, new all-time highs. Discretionary, not quite there yet. It's a little bit below the all-time high. So what Lindsey said is, people buying, needed goods, the staple items, that has been strong. I think Walmart told us that last week. I think Target, which reports earnings this week, is going to say the same thing. And, it's just a matter of, as Lindsey said, trading down right now. And if that trend continues, if inventories build, margins are going to take a hit. And, it could be present quite a few more problems at the end of the year.
I have one thing I wanted to add real fast too, is I went back and looked at Costco to kind of look at this discretionary trade down thing. And do you know, they still do the monthly sales reports. I don't know if anyone actually reads them anymore.
I love those. Hey, I love those. I read them every month. And I compare them against the monthly retail sales report, and it shows that they continue to take wallet share. So there you go.
Yes. As a retail analyst way back in the day, I hated them because it was like, the month and just flew by and it's back again. But,
True.
No, but there's a lot a lot of little good nuggets of info in there. And so Costco's July report, their non-food comps were up low double digits. That's huge. So if the consumer is buying discretionary items, they're going to Costco. They're going to Sam's Club. BJ's is going to report earnings. We'll find out what they have to say. You know what I thought was also funny within that non-store or non-food comps, is the gift cards were very strong. And you know what kind of gift cards you can buy? Because I buy them there. So, you can buy like local restaurant gift cards there, but you can buy like Xbox. You can buy Domino's Pizza gift cards. And it's like 20% off. So if you buy $100 gift card, you get it for $80. So I do that. I do that sometimes too.
I heard that Costco will offer, and this is probably right up Bob's alley, you can buy like a $500 credit of Southwest airline tickets for like $450.
That's pretty cheap. But I would tell you also that, Lindsey, if Chris is on your Christmas list, if you can get a gift card that allows him to buy as many Costco hot dogs as he wishes, I'm sure he would be very appreciative of that.
That would be the gift that keeps on giving.
I think I did read that too, that the cafeteria area did well in the month.
Have you guys heard that people are having birthday parties at Costco where they do like a treasure hunt? They do a treasure hunt in the store, and then they gather in the cafeteria area by some of the tables. They get like hot dogs and sodas, and then they get a cake from the Costco bakery.
Brilliant idea.
When's your birthday, Chris? Bob and I will plan it.
It's soon. That's all I'll say. Because then you're going to go, when's your birthday? Oh, how old are you? And of course, we don't talk about that. So, but let's move on. We've got to talk about having a number of retailers reporting in the next couple of days. Lowe's, Macy's, Target, TJX, Urban Outfitters, Guess, Williams-Sonoma, Dollar Tree, Ross Stores, and a couple others on the fringe. We can throw in Peloton. You mentioned BJ's, Lindsey. Bob, if you had to pick one to watch, which one is it and why?
I'm going to be watching TJ Maxx. I'm kind of tied with TJ and Ross Stores. It kind of do similar things, but I think TJ really hits the heart of where the consumer is shopping. They reported a really strong earnings report back in May. Stock went up and came back down, and it bounced right back up, and it's been very, very strong. In my experience, we often see when a company comes out with strong earnings, maybe if they surprise to the upside, that usually runs about 3 quarters in a row. So this would be number 2, and then maybe the next report that TJ comes out in November. Again, this is very non-scientific data, and this is interpretation from me. It's just my anecdotal evidence. But if we see 3 quarters in a row, we might see another quarter after this one. But I'll be watching TJ Maxx, especially to see how much the consumer has been spending. Again, a lot of sales from TJ Maxx are oriented towards furnishings and also some back to school stuff as well too. So if they have good earnings report this week, it'll be something I'm looking forward.
Go ahead, Lindsey.
You know me, I'm watching Target because of what I've just said previously. I think not only is it the most important earnings report for the week, but it's almost acting as an economic indicator for the week. Of course, we have jobless claims, but I think this is going to be another telltale read, a big read on the consumer for the week. And I think that it's going to either confirm or show a different story from what we, thought was what we heard from Walmart.
So their grocery business isn't as big as Walmart or Costco. Does that make you a little nervous that perhaps they might be losing some foot traffic out to these other guys?
Yeah, I mean, they have a greater discretionary mix than a Walmart will. They also have a higher income consumer than a Walmart would have. So the interesting thing is Walmart taking the Target customer right now? Are they trading down? So I think we're going to find that out. And I think from what I read in analyst reports, what I've seen is earnings expectations for the quarter have come down. And also, it's looking like for the third quarter for Target, a lot of analysts are talking about how comps and traffic for Target aren't doing as great in the third quarter, which is the back to school season that's important for Target. So it's going to be an interesting and important report. It might have repercussions that spread across the marketplace.
So not to cycle back to Costco, but do you know what the average income is for Costco members compared to Walmart shoppers?
I don't know, but I know it's high. It's like high income, isn't it? What is it? Tell me.
It's for Costco, it is 125 to 150,000. For Walmart, it's closer to 80 to 85,000.
I suspect Target would probably be closer to where Walmart is than Costco, right, Chris?
Yeah, I think that's right. So the one that I'll be watching this week is not one that either of you mentioned or one we've talked about. It's going to be Williams-Sonoma. And the only reason for that is because their consumer tends to skew higher. And I want to see, are they putting up the comps that people think that they are? Are they still seeing people shop? What's their outlook? And then I kind of, want to compare that to some of the names that we have mentioned just to see where are consumers continuing to shop. I will share too, I think the biggest risk that we see is something that you touched on, Lindsey, is that these companies deliver good results for the July quarter, but they don't change their guidance for the full year, which means the back half of the year is probably a little weaker than expected. So we're going to have to do some analyst math, I think. Bob, put it all together. What does it mean?
Yeah, it just means that we have to be paying very, very close attention to the consumer data. The retail sales really hit at the heart of where the consumer is in the economy. The consumer represents about 70% of the GDP for the United States. And we want to really have a good idea of if that growth is continuing now. And we did see that strong retail sales last month. And, it may slow down for the August reading, which comes out in September, and which is just out before the next Federal Reserve meeting, which comes out towards the end of September. So I think the Fed as a committee is looking at the growth of the economy. They're looking at inflation. They're looking at jobs. And I think Lindsey said it best last week, is as long as the consumer or as long as the average American has a job, they're going to continue to spend. I might paraphrase you there, Lindsey, but I think that's kind of what you mentioned last week. And I think it's very right and very appropriate to talk about that. But we got to pay attention to what the consumer is doing.
I think it comes down to degrees. If they are going to spend, are they going to spend more? They're going to spend less. And as we're talking, it looks like they're spending less. But you almost had a perfect segue there, Bob, to our second topic when you were talking about the Fed. Everybody knows that, the market has been pricing in various rate cuts. Some think the Fed will start in September with 25. Some still think the Fed may open the door to a 50 basis point rate cut. But in my opinion, that makes what Fed Chair Powell is going to say Friday at Jackson Hole very important. And yet, I don't think he's going to say that much.
I agree with you, Chris. I don't think he's going to say that much, but I will say, I also agree with your point on it being important. In fact, I think this speech combined with the September meeting is actually going to be quite consequential for Powell and the Fed in terms of reputation and credibility. Forget the transitory mistake. We are at a very, I think this is now their time to either shine or screw it up in a big way. And you don't know where they're going to land because it's a fine needle that needs to be thread. They talk about, just to go over what we quickly know is they'll say inflation has eased substantially, which it has from 9%, right? But that rate of decline has stalled out, and there's some sticky parts like shelter and auto insurance has remained very sticky. And then you've got the job situation. It's starting to weaken. We're going to get revisions on Wednesday of this week that are expected to be pretty bad. So, and that's
up to a million jobs. That's a crazy number. And at the same time, not to steal your thunder, Lindsey, but you look over the last couple of days, Cisco, right, announced layoffs. MasterCard announced layoffs. And there's a sea of, I would say a sea, but a growing list of other companies that are announcing layoffs as well. Cisco, for example, Intel came out, and again, some others out there. So I do think that the employment situation is going to come to the forefront of the conversation. But, Bob, I watch Powell talk and testify in front of Congress. He doesn't give anything up, right? He always talks about we're in between meetings, wouldn't be appropriate to comment. He says the data is getting better. I agree with Lindsey. I think he's going to come out and say that they have more confidence, more comfort in starting a rate cutting cycle. But I still think he's going to keep his cards super close to the vest, even if everybody knows it.
I agree with that, Chris. And I think that Chair Powell will be coming out and basically reiterating the same thing that he said in July, at the end of July, at the last meeting. Of course, this week we're going to be getting the reading on the minutes from that meeting midweek. So we'll be digesting.
Nobody cares.
I do.
It's the past. It's the past. Look, I might read the Costco monthly retail sales reports, but no one is going to read this report, and I will tell you why. Because we've had more recent inflation data, other economic data. We've had a couple Fed heads come out, Bostic in particular. So I look, will I read it? Yeah, I'll skim it, but it's going to be a non-event, Bob.
Fair enough, Chris. But as I'm a Fed nerd, and you know that, and I've been following the Fed for years and years and years, I will be reading it with my first cup of coffee or a second cup of coffee during the day and enjoying what I'm reading. As I know it sounds bad.
Wait. You have your second cup of coffee at 2 p.m. in the afternoon?
Well, it's a big cup of coffee, so I'll have my second.
You are woefully undercaffeinated and not supporting Starbucks at all.
No, not supporting Starbucks. I'll be at Starbucks later in the day. But to be honest with you, I really don't think that the chairman is going to say much different than what he said in the press conference after the last meeting. I do agree with Lindsey, though, that this is an important meeting to set up the crowd out there, the traders, investors out there, for what the next move is going to be. I've said for the past 2 or 3 months that the Fed is pivoting, but they really don't know exactly where that pivot is going to move. If they're turning the crank, they're going to pivot out to a dovish policy. What Chair Powell said at the last meeting and the meeting before that is one rate cut is not going to matter. And he's correct. It's not going to matter at all little beans. But what matters is that they start that rate cutting cycle, and that could lead into 3, 4, 5, 6 rate cuts before they're done, which could happen in 2026. I do believe that they are going to take a gradual approach. They're not going to speed through this thing. If they do, they run the risk of overheating the economy, especially if we ramp up into the end of the year with holiday shopping and holiday sales, lower gas prices. If that comes out over the next few months, so I do think they have to be careful. They have to be calculating. They're measuring those risks as they always talk about. But I think by and large, nothing's going to be different. And I think the market has gotten ahead of that, Chris. And I think that what the problem is going to be maybe towards the end of the week, towards the end of August here, as we move into the fall months, I think what the problem is going to be is that the market has gotten way ahead of where the Fed is right now. And if that's the case, there's going to be some disappointment and the markets could come down.
Yeah,
Wow,
but that
it's too
isn't
bad.
a problem. That hasn't been a problem all year.
And what? Are you being sarcastic? You better be sarcastic.
No, I'm serious. Like at the beginning of the year, we were looking for 6, 7 rate cuts.
The market was way out over its skis. They were addicted to hopium for these rate cuts in the very early part of the year.
And the market did fine.
Until April came around.
Dropped 4% in April.
Oh, yeah.
Pretty good size drop. And small caps have been basically kneecapped all year long. So except for about 3 weeks there. So
let me just wrap this up, and then I'll hand it to you, Lindsey, to tell us what it means. But I think that the bigger risk on Friday is that Powell, to the extent he plays the straight shooter, the big concern is that what if he's not as dovish as the market thinks he might be? We know he's not going to be hawkish. That's a given. But the question is, how dovish will he be as he keeps those cards, like I said, close to his vest? But Lindsey, wrap it up. What does Jackson Hole mean? What's the key takeaway for folks who are listening?
Look, what I would say is Jackson Hole hasn't historically created much of a reaction in the market. For the most part, there's always an exception to the rule, right? 2022 was one of those when he got kind of hawkish on price stability. But I don't expect the market to react significantly. I do think the key is going to be that he's going to talk about what Bob said, that the pace of rate cuts is going to be gradual, because that's the best chance that we have at a soft landing. If we're cutting aggressively, it means that we're in deeper trouble than we think we are. But also, to your point, I do think that people are looking for any sort of dovish tones. They're looking for what he has to say about growth, because he hasn't really talked so much about growth. He did say in July that, he doesn't want to see the job market get much worse than where it's at. And that was before the July jobs report came out. So I think it's going to be a non-event in terms of market reaction, but I think it's going to be a big event in terms of what he says and how people extrapolate that into September. So I think it's going to be one piece of the puzzle as we work our way to September 18th.
I agree. And it's another reason why folks will have to keep coming back and hearing how we put those puzzle pieces together. And one puzzle piece that I'm watching, and I think you guys are too, is this thing that apparently is going to happen in Canada on Thursday, a dual rail strike that has the potential to really upend North American rail traffic. And, I don't want to get out ahead of this and be all, the sky is falling, Chicken Little. But, when we've seen strikes and work stoppages, the big question is always duration, right? If it's relatively quick, it might be a little bit of a blip. But if it's extended, not a couple days, but it moves into a week, 2 weeks, 3 weeks, that's where the bigger risk comes, not only to the economy and potential renewed supply chain issues, but that could really throw a thorn in the inflation-deflation narrative that we're seeing in the marketplace. And it could be a wild card for the Fed. What do you guys think?
Yeah, I mean, I agree with you, Chris. It's something not a lot of people are talking about, but it could have huge implications for inflation from a food perspective. That's where the pain point is for most American consumers, right? And this is happening just months before the election, too. So, I mean, that's what I'd be looking at. Is the inflation impact. Hopefully it only lasts a day or two. But I think it's also the other thing I'd add is it's another sign of, that the angst that exists between employer and employee. Unions are still a very small portion, represent a very small portion of U.S. employees. But obviously they've shown increasing power, and the employee base has shown increasing interest in them over the last several years. I don't think that's going to change significantly. There's an imbalance there between,
Agreed.
I talk about this in my newsletter, the shift all the time. There's an imbalance between the employer and employee relationship, which is a result of the employee contract being out of balance. So I don't know. It's just something to watch to see how that develops. And I think it's just a sign of bigger underlying trends there.
Bob, could this turn out to be a big nothing? Is it possible that Union Joe Biden comes out, talks to the Teamsters and say, hey, boys, get in line. This is an election year. We'll make you whole later, but we can't risk a big apple cart getting turned over for the economy here, not when we're so close.
Well, just a few years ago, we had a rail strike here in the United States, and one that was stopped right before the workers hit the picket line. So I think there is a lot of fear out there that something like this could last for quite some time. There's the potential for disruption here. And I think a lot of these companies that are transport oil from Canada down to the United States, they do that through rail. And if that's disrupted, you could have a good spike in oil prices, at least in the short term. That certainly could be the result of a disruption in rail. But certainly moving product from Canada down here and vice versa from here up to Canada around the holiday time is going to be a big disruption for businesses as well too. And the longer it lasts, the worse it's going to get. I will tell you that union workers these days, especially after President Biden's been in office for nearly 4 years, have a lot of leverage with some of these companies these days, and they've been able to negotiate great deals for themselves. And this could just be another opportunity for them to pick off a little bit more off of some of these Canadian rail companies if they really turn the screws on these companies.
Okay. So I think when it comes to this particular topic, the what does it mean takeaway is we don't know exactly. We're going to have to wait and see and kind of, check out what that duration is. And based on the clock, we'll have a better sense of what the economic impacts are, supply chain disruptions, and potential reinflation pressures emerging. Let's turn quickly, panel, to our last topic. Earlier this week, where it is Vice President Kamala Harris and presidential candidate is proposing to raise corporate tax rates 28% from 21%. But on the other hand, and if she does this, that's one thing. Of course, this is campaigning. She needs to get elected, needs to get passed, all of that. Let's not jump the gun. But there's also the expiration at some point of the Trump tax cuts. So what I want to put forth out there is whether it's 2025 or 2026, there is the potential for corporate tax rates to be higher. And yet, when we look at consensus EPS numbers for the S&P 500, at least for 2025, that's up a whopping 15% year over year compared to 2024. And usually about this time of year, when you look forward, it's this, rule of thumb, 10% that tends to get adjusted, usually lower. But does this pose a bit of a concern, or should it be a concern for folks as we start to think about 2025?
I mean, I think it's already on corporate minds right now. I think as we're going into the election period, I think it's part of what you're seeing. It's not just the consumer that's slowing down. Spending and confidence, corporate confidence, is slowing down as well. And so part of that is because we don't know who's going to be in office. So that means we don't know what tax policy is going to look like. And that's going to have a huge impact, like you just said, on the bottom line for a lot of these companies. And what has an impact on the bottom line is going to have an impact on the SG&A line too, probably. So it is certainly a concern to watch going forward. Of course, then you can offset that with, what does it mean for our deficit, right? So
right.
I think it just adds to the storyline that I've been talking about. Like, there's a stalling in hiring for a lot of reasons. What's happening with interest rates, what's happening with the election, but also nobody talks about the fact that these tax changes could have an impact.
I agree with that. And also the fact that companies are going to be crying about this 1-2 punch of higher wages and then higher taxes affecting their bottom line. I'll tell you this, I don't really see that a lot of these firms who have been subject to pay more wages have really been hurt all that much. I'm not going to paint a broad brush saying every company is quote unquote lying about how they've had their arm twisted and with increases in the wages. I saw General Motors actually reported great numbers. They didn't talk so much about the pain that was administered by the unions with a change in contract, but other companies did. But I'll tell you that the higher tax rates could be a problem, especially if it gets up to that 28% level. I agree with Chris though in the fact that it's more posturing, it's more political rambling right now to throw these numbers out there, trying to get something passed without, especially if we have a split Congress and Senate, it's going to be difficult for any candidate to get something like that across the finish line. But I do think that the talking about it is a big thing. Let's not forget though, if former President Trump gets in there, he's talking about an aggressive stance with tariffs, and those taxes are going to have a big effect. I think Lindsey talked about tariff taxes having a huge effect on inflation. from a negative standpoint. So if the tariff taxes are up, inflation could certainly creep back into the economy.
Individual taxes also expire, which obviously benefit the higher income more so than the lower income. But there's also the child tax credits, there's higher standard deductions, things like that. So it impacts the individual, which impacts spending too.
Agreed. It sounds like one way or another that when we look at least from a market perspective, we are going to have to pay more attention to this one way or another. The odds are that any tax rates are going to go higher. To the extent that does happen, it means we're going to have to revisit EPS expectations for the market. That will call into question the market multiple. So it's another thing to watch over the next couple of months. And with that, folks, hang tight. We'll be right back. We'll wrap up today's podcast. All right, folks, we are into the home stretch where we share with you our own takeaways from the conversation that we had today. Bob, why don't you kick us off?
Yeah, so we have the Big Jackson Hole Symposium, which is being hosted by the Kansas City Fed this week, and all eyes and ears are going to be on Chair Powell. Is he going to throw some meat out there to the hungry lions who are looking for something to chew on here? The problem being for me is that markets have risen quite sharply. We're right near all-time highs on the S&P 500 and the Dow Industrials as well too. Not so much on the NASDAQ and the Russell 2000 right now, but I think that if he throws a bone to the market, we could make a good run into the end of August. August has traditionally been a poor month leading into September. But if we have if he throws a bone to the markets and says, yeah, you know what, rate cuts are on the table, and we'll be talking about it at the next meeting, then it could be off to the races, regardless of the fact that we're super overbought in the short term.
So my takeaway is, I'm just going to add on to that and say something we haven't said yet. Part of, I think, why the market has done well is because of the move, and we haven't talked about this in depth yet, so I'm just going to give it the quick synopsis, is that part of the reason I think the market has done so well is because of the move that we've seen in interest rates. I mean, in just the last 3 weeks, we saw interest rates go from 4.25% to 3.8, 3.9. That's a difference. Doing the work for the Fed already. And I know maybe next week we'll dive into that more, but we can't overlook that.
Totally agree. And I think it supports something we did talk about earlier, which is that the market is really anticipating that Fed rate cutting cycle potentially starting either sooner or larger than what could happen. But it is something we'll have to pay attention to. My surprise learning out of our conversation today is something that Lindsey said, and I will be taking her to task with it next week. That is that the big event this week is earnings from Target. I'm fascinated by that because I kind of see Target being left behind a little bit. I talked with Bob, several months ago about how I think that Target is a little lost, and we will see how that pans out. I'm curious to see what they have to say about the back half of the year. But folks, that's just more fodder for us next week. Hopefully we'll have a little more on the potential Canadian rail strike. We'll have more on retailer earnings, and you can bet we'll be breaking down all that Fed Chair Powell has to say. So be sure to tune back in next week for another edition of What Does It Mean? We'll see you then.